Hey guys, welcome back to the channel. Now, I saw this great piece on the Kobeisi letter, which is a financial publication. They actually put out some really interesting stuff on X. And it's mostly going to be about the Trump administration's decision to stop large institutional investors from buying up single family homes. So, because there's been a huge trend of a lot of investors and predominantly as well, large investors. Companies like the Blackstone group, which lost about $17 billion in total value today, their shares dropping from $164 to $151, purchasing single family homes and then renting it back to families as a way to be able to generate an income. Hey, before I continue, if you like this video, give it a like and a thumbs up, and also subscribe. I'm trying to get to 500 followers or subscribers here on YouTube, and to get monetized. And I really need your help. Thank you. A lot of this started during the pandemic, where the property market wasn't particularly hot, and we saw a flattening on a lot of income producing products. And we saw a lot of money being deployed into real estate investment trusts. And what they predominantly began doing was purchasing single family homes and renting it back to people, back to people in the market, to be able to generate higher incomes than they might be able to do from, say, a corporate bond or government bonds, etc., to be able to generate returns, as any investment company would do. But as a result of that, we actually saw the number of transactions of investors buying single family homes rise from about 14% to 27%. So we're talking about a solid doubling of the number of transactions happening from investors in 2020. So that was 14% to now, which is about 27%. Now, as you can imagine, as demand increases from this new group who are, really investing a lot more into this resource, naturally that's going to cause for the actual property price of the asset to rise. And you can kind of see this graph here to kind of show you how much the share of total purchases has been for investors versus, in 2020 versus now. Now, as a result, and as the actual price of the asset rises, and also we're having the knock-on impact of interest rate rises, it's basically caused for single family homes to be completely unaffordable for most people. And, proof of that is that we can now see that the average age or the median age for first-time buyers, home buyers in the US, has actually risen from 33 years old in 2021 to 40 years old today. Just to give you a little bit of context, in 1981, the average age of home buyers was 29 years old. So we effectively saw affordability and the ability for people to buy homes get pushed out by 7 years, on average, in a very short period of time, whereas it changed very minimally from 29 to 33 over 40 years. And so this has a clear indication that home unaffordability, has skyrocketed in the US. Now, I don't know if you've seen some of these articles, and I'll kind of post a few here as well, but it's different studies looking at the unaffordability of home, and also just home costs, whether it's rental or also buying a home in multiple major US cities. And I think it turned out that if you use traditional finance conventions, investing X percentage of your income into your home cost, so let's say 30% into your home costs, I think there was almost none, or very few major cities in the US where a single person could actually afford to buy or rent, say, a 1-bedroom apartment in that city, which is insane. And, a big part of it is things like this. Now, back to the initial topic. So it's risen significantly, home buyers. Now, the interesting thing is when you look at the actual share of of purchases by large and mega investors, which is what these are being classified as, which Blackstone would be classified as, or other real estate investment trusts. It's about 20% of investor purchases, but it works out to be about 3% of total overall home purchases. Now, if you're looking at a market and demand for an asset or a product or a service drops by, let's say, 3%, it's not going to have a great impact on how much that asset is worth, because if the asset's gone up, it's already gone up and it's kind of going to stay there. But also the ongoing knock-on impacts of those investments isn't really going to be that great. Now, you can see from this chart here, there were periods in time where mega investors were anywhere from about 20% in their own right, and then large investors were roughly around 10%. So a much larger share of the pie, but not significantly more so than it is now. What we're actually seeing is small and mid-sized investors or medium investors be able to be a lot more nimble and do a lot more transactions because there's so much more of them than what you might find elsewhere. So what's interesting is, what is a medium investor? Now, if you look at what medium investors are, they tend to be much smaller, still real estate investment trusts who are investing in apartment buildings or single family homes, etc. So again, they're like mini versions of Blackstone that operate in the same way and have a very similar impact to what large or mega investors have. They can be a bit more nimble. There's so much more of them. So ultimately, blocking just large and mega investors doesn't have as much of an impact as you might think it does. So you can see here a chart here that kind of shows the share of small, medium, mega, and large investors, and what percentage of single family homes they're buying. And you can see here that the impact is very small if you were to remove the large and mega investors from purchasing single family homes. Another thing that you can see here as well is that number's dropped off by quite a bit. Large investors used to purchase anywhere from about 5% of the total home values of the total home transactions in 2019 or 2020, but that number has significantly dropped off. Ultimately, they probably still own those homes, and that capital has been deployed in those homes. So, it's not going to be undone, but they have significantly slowed down on their purchase of single family homes. So it kind of feels a little too late. And it doesn't feel like it's going to have much of an impact. To be honest with you, even if you look at the total investor impact in the market, if you were to drop 3% from large and mega investors, it doesn't feel like it's going to do a huge amount. If you were even just to look at the total investor transactions, so if demand dropped by about 27% or 27% or so, it definitely would do something to the price. But I don't think it's going to bring about the affordability that people think it will. Also, as well, if you look at demand for purchasing properties, it's at an all-time low. It's about half of what it was in 2020. Looking at this purchase mortgage application index, as a weekly chart, you can see that demand has effectively fallen off a cliff. It's significantly lower now than even during COVID, where you literally could not go out and buy a home. So even if you were to remove all investor purchases, demand is still incredibly low. Now, why is demand low? Demand's low because costs are high, and that's, pretty simple. Also, supply is low because companies and house builders just aren't building enough to bring prices down in any meaningful way. So I think that whilst this is interesting and this is something that they should have done a long time ago, and it's news that I welcome, and I certainly think it's something that we should do in the UK as well. I think that ultimately if your goal is to improve housing affordability for young people, you're much better off in looking at the fundamental supply side reasons as to why homes aren't being built. because ultimately that's the only reason and that's the only thing that's going to cause for prices to come down. It's just a lot more availability in stock and a lot more competition for the home buyers that are there, which will lead to people who are trying to sell their homes being a bit more comfortable selling it for a little bit less than what, you know, maybe they think it's worth. And also there's a huge disincentive for people to kind of sell and move, because a lot of people are locked into really good rates compared to what they can get in the open market. You kind of see similar issues here in the UK. I think the only difference is that in the UK, you can actually port your mortgage, whereas in the US, you can't. However, even with porting your mortgage, you know, if you're trying to upgrade from, say, a 2-bedroom flat to a 4-bedroom house, you might be able to port, say, half of that value, but you still need to borrow the remainder at a much higher rate than what you're probably paying now. And when you look at the actual cost of living there, you might think that, you know, it's probably better to rent or stay where I am because it just doesn't make sense to make this move right now. And I think that's ultimately the struggle that a lot of people are facing. And ultimately, what needs to happen is more homes need to be built to tackle this affordability crisis. So whilst it's news that I really welcome, I really don't think it's going to have the impact that people think it's going to have. Look, guys, I hope you found this video super helpful. Please give me a like, subscribe, follow, and I look forward to seeing you guys in the next video.